Welcome back to Module 2, Corporate Lexicon. So in this module, we're going to discuss definitions, which are important for understanding business law. These are by no means a comprehensive set of all the definitions you're going to need to know to practice corporate law or engage in business. But I find that these are topics which are confusing to many law students who are just getting introduced to business. May be useful for people watching this video and give me an opportunity to talk about some of the larger themes and concepts in corporate law. Let's begin. Authorized stock is stock which is created by the Certificate of Incorporation. The Certificate of Incorporation is a document that's filed with the Secretary of State in the state of incorporation. And in it, it will say a certain number. It will actually have to set forth the number of shares which are authorized. A corporation can issue, sell, or give to people only up to the amount of shares which are authorized. A couple things to note about authorized stock is that typically, in order to change Certificate of Incorporation and authorize more stock, you would need shareholder approval, typically the majority of the shareholders. We're going to talk a little bit more about approval in future modules. The important thing here is that a corporation can only issue a certain amount of stock without getting additional shareholder approval, and that's to prevent dilution, to prevent shareholders from losing their percentage interest in the company without their consent. The Board of Directors. The Board of Directors are the ultimate managers of a company. So we learned in Module 1 that shareholders own a company. But importantly, shareholders don't control a company, at least not on a day-to-day basis. Shareholders have limited rights. They can vote, sue, and sell. They can vote for directors, but if they don't like the directors, they have to either remove them for cause in some kind of special proceeding, which is difficult, or vote them out and elect new directors at the next meeting, which also can be challenging. The directors, as a board, as a organization acting in concert, direct the day-to-day activities. This is important to note because directors on their own do not have power. It is directors as members of a board who have power on behalf of a company to make its day-to-day decisions. So the board together will vote on appointing a chief executive officer or making large policy decisions. The board can delegate power to its officers and employees as well within certain limitations. And in order for a board to authorize an action, it needs to meet, actually physically meet, or a telephonic meeting. Skype also works, where there is a certain number of directors present, called a quorum, and a certain number of those approve the transaction, depending on how the bylaws are set up. We'll talk about the bylaws in a second. There are different numbers, different thresholds of votes that are required for different types of actions. The important thing to remember is that directors themselves individually have no power. They have power when acting together, either through a unanimous written consent or through resolutions at a meeting. The bylaws are a written document which set forth the rules and procedures for a corporation. So it will include many things, like who are the officers, what do they do, and how meetings can be called, what notice has to be given, what constitutes a quorum, which is the minimum number of directors or shareholders that must be present for a meeting to begin or to continue, and the number of directors or shareholders needed to vote on certain types of actions. It may also have a transfer restriction on stock. There are many ways to restrict stock, and one way is a transfer restriction in the bylaws. The capitalization table. A capitalization table is a list of who owns what in a company. It's a list of shareholder equity. So shareholder equity is going to be on the balance sheet, but you'll also find it broken down in the capitalization table. You'll see how much everyone has invested. And the capitalization table will include the name of the shareholders and the series of stock and how many shares they have. This is important because if you're trying to decide as a corporate attorney whether an action requires a certain number of shareholder votes, you would look to the cap table to determine how many shares of stock are outstanding and need to be counted, what constitutes a majority, or whatever percentage you need to approve that particular transaction, and then who those individuals are, which constitute that number of shares. It's often abbreviated as a cap table, CAP. The Certificate of Incorporation, or Articles of Incorporation, is a document which creates the company. It's filed with the Delaware Secretary of State in the case of Delaware, or the Secretary of State of another state in the case of other states. And you can think of it like a private constitution. So very much like the U.S. Constitution governs how the government operates at its highest level, the Charter sets forth some of the high-level responsibilities and rights of a corporation. So, for example, it will set up protective provisions for voting rights so that certain shareholders need to be asked and approve certain transactions. This protects them from being diluted from having stock issued, which would reduce their ownership interest. So we have many transfer restrictions. One transfer restriction that comes up is the right of co-sale. The way this works is that if an investor is beholden to others with the right of co-sale, and that investor wants to sell their shares to a third party, the other investors have the right to also sell their shares to that third party. So this can essentially blow up a deal because if I want to get rid of my stock in a private company, and I have and my fellow investors have a right of co-sale, I want to sell it to you, they have the ability to piggyback on that. And so let's say I own 10% of the stock, and there's what we call a pro rata right of co-sale, and the other 90% shareholders have this right. How does that work? Well, if I go to sell all of my shares, the other shareholders may say, no, we're going to sell our shares first, meaning they get to sell 90% of that stock, and I only get to sell 10% of my shares. The investor doesn't care because stock is fungible, and they're getting stock to stock to stock, but I care because instead of disposing of my entire 100%, I might be only able to dispose of 10% of my shares. Common stock. Common stock is the basic stock of a corporation. It has no special rights. So on top of common stock, you'll also see preferred stock. We'll talk about that. The common stock is seen as the most junior security in what we talk about as the liquidation stack. It's going to be paid last when the corporation liquidates. Employees who often get stock options, they get options to purchase common stock. People who purchase stock on the stock market are usually buying common stock. Investors who purchase private company stock, usually in contrast, purchase preferred stock. Corporate level taxation. So by default, most corporations are taxed at 35%, although, as you'll see if you read any news articles, most pay something much less than that. One suggestion I read was that most U.S. corporations pay closer to 13%. But at least nominally, we understand there is a 35% tax on corporate profits. Corporations are taxed as they earn profits. When corporations earn profits, they pay 35% tax, and then they pay tax again when those profits are distributed to shareholders through what's called dividends. So this is what is called double-level taxation. There's an exception to double-level taxation for what we call an S corporation. So there's a form where you can actually check a box and say this corporation shall be taxed as a flow-through entity. We'll define that in a minute. In which case, if it's a flow-through entity, the shareholders will pay tax on the profits as ordinary income. But in general, corporations pay corporate-level taxation, and then the shareholders pay another tax on the dividends when they receive them. It's called double-level corporate tax, and it can be fairly contentious, although we'll find that in practice, it's rarely fully paid at 35%. So what is this dividend? So it's a concept similar to interest in many cases, that a stockholder is entitled to receive a certain percentage of their investment every period. That period can be every quarter, it can be irregularly, it can be annually, and that amount can either accrue or not. It can accumulate. So we have cumulative and non-cumulative dividends. A non-cumulative dividend, if it's not issued that year, essentially disappears. A cumulative dividend means that it adds up, and if it's not issued given that year, it's owed to that investor. It can add to what we call the liquidation stack. So we have two types of dividends, cumulative and non-cumulative. We also talk about dividends as being regular or special. So a regular dividend is one which must be given, and so most of the time this comes up in the context of preferred stock. So a preferred stock agreement may say that it's going to have 8% dividends annually. We'll specify cumulative or non-cumulative. And then on top of that, if the corporation has excess profits, it can, the board of directors can decide to issue that as a dividend to the common and the preferred. Equity. So equity is a type of security. There are two main types of securities in corporate law, equity and debt. And it's a type of security issued by a corporation that represents an ownership interest. So here we again say shareholders are a type of owner. They're owners with limited rights. They can vote, sue, and sell. They can't run the day-to-day corporate affairs. And that ownership is expressed in an interest called stock. So stock is the most common type of equity we discussed in my class. Although debt is also brought up and is important. The amount of stock is counted in shares. And I use the term stock and shares interchangeably. Flow-through entities. So I briefly alluded earlier that there was something called a flow-through entity, an S corporation. There are other flow-through entities, limited liability companies, partnerships, etc. What does that mean? A flow-through entity does not pay corporate level taxation. Again, corporate level taxation was at 35% tax nominally that corporations pay on their profits. And then there's additional tax paid on dividends, the profits that are paid to the shareholders. In a flow-through entity, there's only one tax to the shareholders or the members or the partners of a LLC or a limited partnership. What does that mean to be a flow-through? That means that the partners or the flow-through shareholders or the members will actually pay on their own as ordinary income the profits of the corporation. This can create an issue called phantom taxation. If the corporation generates profits but does not actually distribute them, the people that are members or shareholders of that corporation can end up owing tax on that profit. Someone has to pay it in that year, even though they didn't receive any actual cash to pay those bills. Futures are an obligation to buy or sell something in the future, an underlying asset. So the way a future will be constructed is that you get a certain asset, a right to buy it or sell it, at a certain price at a certain time. So if you've ever seen the movie Trading Places with Eddie Murphy, you might have learned that concentrated orange juice and pork bellies are some common futures. They're different from options because a future gives a person a choice to buy something in the future or to sell something in the future. We have put options and call options, whereas a future is an obligation to do so. A put it can be seen as a short or a long position. The point is that a future is something you have to do in the future, and so how do futures actually work? Most investors purchase futures without actually desiring to take possession of the underlying asset. So what they'll do is they'll resell or roll over the contract to somebody else so that someone who actually wants it eventually gets it. Futures are used for both speculation and for hedging, which we'll talk about. A green shoe option. So a green shoe option has regarding a green shoe option has to do with an initial public offering, and it's when a company can sell more shares. Let me give you an example. So recently, Alibaba had a record-breaking IPO. They sold 320.1 million shares for $68 billion. For $68 each. Alibaba sold 320.1 million shares at $68 each for a total of $21.8 billion. The underwriters, which are the people that essentially buy the stock from the company and resell it to the public, have an option called a green shoe option to sell additional shares in an IPO. So how does that work? Well, in that case, there was an option, a green shoe option, to have the underwriters purchase and resell 48 million additional shares. And as a result, the Alibaba IPO turned out to have sold a total of $25 billion worth of stock, making it the largest IPO in history. The green shoe option, also called the over-allotment option, is at the time of the IPO, the opportunity for the underwriters to purchase more stock if things are going well. Hedging. Hedging is sort of the opposite of speculating. So hedging is when you buy a security whose price is expected to move opposite to something else you own. So for example, if you own a gold mine and you make more money if gold costs more money, and you make less money if gold is worth less, you may hedge against that by shorting the price of gold, meaning you buy a security whose price increases when gold decreases. So in that way, if you hedged perfectly, you would never make any profit. You would essentially, if gold went up or if gold went down, it wouldn't matter to you. You'd be ambivalent to those because you'd be perfectly hedged. You would have an asset which, your gold mine, which increased in value as gold became more expensive. You have an asset, short, which would decrease in value as gold increased in value. So by having these two different securities that move completely oppositely, you would be indifferent as to the net price. An initial public offering, or an IPO, is when a private company becomes a public company, when it lists its shares with the SEC or NASDAQ or another stock exchange. After the IPO, a company can freely sell its shares that are registered on a public market. So we talked a moment ago about the green shoe option. The way an IPO works is that typically, there are some exceptions. Google had a stranger thing called a double Dutch auction, but in general, an IPO works where underwriters agree to buy the shares from the company at a certain price, and then they resell them on the open market, hoping to make a profit, called the spread. The underwriters have a big impact on the pricing of the IPO, the number of shares that are sold, and they typically reserve an option to purchase additional shares if things go well, called a green shoe option. Liquidation. Liquidation is the winding up, the end of the company. It's the death knell for a company, and it can happen in many ways. One is the company doesn't do well and dissolves, it liquidates, and distributes its assets to shareholders. That's an unhappy ending. A happier ending for a corporation is that it liquidates a merger or acquisition by being sold to a company, and the shareholders receive profit, proceeds from that sale. A liquidation is the end of a company. It can occur because of a bankruptcy or a sale of the company, or because the company simply decides it doesn't want to continue going on. Notably, an introductory public offering is not a liquidation. When we have a liquidation, we look to see who gets paid by looking at the liquidation preference. So we talked about preferred stock. Part of the reason it's called preferred is it has a preference. It gets paid before common stock, and it gets paid some multiple of what was invested. Generally, more recent investments are paid first. They're more senior. So we have a principle of last in, first out when it comes to investments. So typically a private company is invested with, you have common stock issued to founders, that is Series C or Series A is the initial fundraising round. Then you go on and have Series A, B, C, D, E. As the company grows, needs more capital, gains more investors. Typically the last series, in that case Series E, would be the most senior and would get paid first. So it would be at the top of the liquidation stack, what constitutes the waterfall. So when you get paid out in a merger, when a company mergers and ceases to exist independently, and the proceeds of the merger go to the stockholders, you can picture the money kind of flowing into a pool, and it will fill up first the Series D, the most senior security, the most senior preferred security. Of course, debt needs to be paid before any stock. So once the debt is paid, the preferred can get paid, and the most senior preferred gets paid first, and it gets paid its liquidation preference, the amount that is owed, which is typically some multiple of its investment. It can be a multiple of 1, meaning they get paid their original investment back, or it can be a larger multiple, like 2x. So if the Series E invested $10 million, they get $20 million before any other shareholders get anything. Long. So we have long and short positions in hedging and speculation. The long position is the position that will increase in value if the underlying asset's value goes up. So it's your standard stock investment. When you buy stock, you take a long position. We spoke briefly about preferred stock, but to be clear about it, preferred stock is typically the way venture capitalists and private equity funds invest in private companies, and some public companies also sell preferred stock. Preferred stock has preferences. It has a liquidation preference. It has the right to be paid first. It has the right to be paid some multiple. It may have other features as well. For example, it usually can convert into common, and sometimes it can get paid its preference and then still convert into common. Some people call that double dipping. It's called participation, technically. So preferred can participate, has many other features. So when you sell preferred stock, it's a highly negotiated type of stock. Unlike common, which has very few features, the features of preferred stock make a big difference economically, and so they're typically highly negotiated, highly customized. Private company. A private company is distinguished from a public company in two ways. One way to think of a private company is a company that's not listed on a public stock exchange, like NASDAQ or the New York Stock Exchange, NYSE. Another way to think about a private company is one that's owned by individuals and not by the government. The government can own corporations. It can own municipalities. There are municipal corporations. And so we'll move on. Those are described as public companies. Public company, again, can have two meanings. It can either mean a company which is listed on a stock exchange, or it can mean a company which is owned by the government, by the people in common. In my class, I typically use public to denote a company that's on a stock exchange. There are many transfer restrictions. We mentioned co-sale. We mentioned restrictions in bylaws. The third we'll mention is the right of first refusal. So our three transfer restrictions: bylaw restrictions, co-sale restrictions, and right of first refusal. What right of first refusal means is that if I want to sell my stock to you, and I'm subject to a right of first refusal, which usually comes about by entering into a right of first refusal agreement with other investors. If I want to sell my stock to you, I have to give the other investors a chance to buy that stock first, which can make it unappealing for you to enter into the deal at all. Essentially, it says that before I sell my shares to an outside party, I have to sell it to other insiders. The SEC, or the Securities Exchange Commission, is the U.S. agency in charge of regulating securities. So it's the primary regulatory body for all securities and most company-related things. Some of the major laws that they deal with are the 1933 Securities Act, the 1934 Securities Exchange Act, the 1940 Investment Advisors Act, the 1940 Investment Company Act. Security. So security has a very long definition by the SEC in the 1933 Act, which I won't read to you here, but you should look it up. It's incredibly broad. The gist is that according to the SEC, basically anything you can imagine that is like a stock or a loan is a security. What do you need to know about securities in order to understand corporate basics? Well, first you should understand that stocks are an equity security and bonds are a debt security. Both are securities. Both are regulated by the SEC. Both are regulated by other federal laws, such as the Sarbanes-Oxley Act of 2002 and the Dodd-Frank Act of 2010. And equity and debt are regulated differently and have different rights, but they are both securities. Again, the meaning of the security is very broad. So anytime a company is raising money, it's important to ask whether or not it's selling securities, which would cause it to be regulated unless there's an exemption from regulation. A shareholder meeting is when the shareholders get together and vote for the directors, and they may also vote for what are called precatory proposals, which are suggestions to management, and they also may be able to amend the bylaws. There can be special meetings as well as annual meetings, but all corporations are required to have an annual meeting of stockholders. And at that time, shareholders have the ability to exercise their right to vote. So a short position is the speculative bet that something will go down in price, or a hedge that you think something will go down in price. So when would someone short something? Well, there's quite a few reasons. If you think the market, you think the stock market is priced too high, you may short the stock market, and you will profit if the stock market goes down. So basically, a short is when you make money if the value of the underlying asset goes down. Speculation is distinguished from hedging in that it's the bet that something will go up and down, as opposed to using a short or long position to compensate for exposure. So hedging is when you have a certain asset that will rise in value, and you purchase a security that will diminish in value under similar circumstances. So, for example, a hedge might be the airline industry uses a lot of jet fuel, and so it could purchase jet fuel in advance, so that if the price of jet fuel goes up, the cost of its operations go up, but it also has this valuable commodity. And so net, they don't win or lose as the price of jet fuel changes. And in that way, airlines don't have to worry about the risk of jet fuel as long as they're willing to pay, some transaction costs to hedge. Speculation, on the other hand, is the person sitting on the other side who doesn't run an airline, but thinks that the price of jet fuel will move in a certain direction. And as a result, is willing to take the opposite position of the airline, that it will move in a different direction. Whatever direction the airline thinks it will move in, they will take the opposite position. So in order to have a long or short position, someone needs to be on the other side and take the short or long position, corollary position. And then speculation then is taking risk, whereas hedging is eliminating risk. So what is stock? Stock is shares of ownership in a corporation. It's counted a number of shares. But it's also important to know that percentage of total stock is going to dictate whether or not an action can be approved or what someone's entitled to. So for example, if a company has 100 shares of stock and you have 10 of them, you have equal rights as if the company had 1 million shares of stock and you had 100,000 of them. In either case, you have 10%. It's very important to think about stock as a percentage and not as a total number. But it reflects your ownership in the corporation, and it can come in different types. You can have preferred, common stock, and each of those can have each of its own characteristics. Stock options are the ability to purchase stock in the future. Now, as opposed to futures, which are a requirement to purchase or sell something in the future, an option is what it says. It's an option to buy in the future. You are not mandated to make that transaction. So stock options are usually given to employees and directors. How this works is that on a certain day, the option is granted, meaning the employee gets the ability to purchase stock in the future. Typically, however, that option doesn't vest, meaning it's not available to be exercised or used at that point in time. So let's say on day 0, you're the employee of Microsoft, and Microsoft gives you an option to purchase 50,000 shares of stock and vests over a 4-year schedule with a 1-year cliff. Comment. What does that mean exactly, to have it vest over a 4-year schedule with a 1-year cliff? That means that on day 0, although you have this option to purchase 50,000 shares, you're not able to use that option for a full year. You have to work for the company for a year and remain in good standing in order to be able to purchase 1/4 of the stock, and then every month after that you can purchase an additional 1/48 of it. What price do you purchase it at? Well, that's determined at the date of the grant. Thanks to an IRS Rule 409A, that has to be the fair market value at the date of the grant. That's called the strike price or the exercise price. So when you get an option, it has several features. It has a vesting schedule, typically, and it has what we call a strike price, a price that you have to pay for it. What you're looking for is a stock. You would purchase the stock, you would exercise the option if it moves through the strike, meaning if the value of the stock at the time of your ability to exercise exceeded the strike price, it would be in your interest to do so. And so an option is more valuable the longer it lasts because you have a longer time period to determine whether or not the stock will move through its strike and stay at its strike. And you only have to make the transaction when that occurs. We talked briefly about an underwriter. An underwriter is a person in the context of an initial public offering who's going to help the corporation issue and sell securities. They'll actually receive a fee and the ability to make a profit by purchasing the new common stock. Typically, common stock is sold in an IPO from the company going public, and then it will do the resale to the investing public at the capital market. So the underwriter is a risk taker in a transaction, and it comes from an old practice, the term underwriter, that the underwriter really wrote its name under the amount of risk, the amount of shares it was willing to purchase or accept. As I mentioned earlier, underwriters often reserve the option to purchase more stock in what is called a green shoe. So that's the end of Module 2. Hopefully that helped you understand corporations with some basic definitions.